This is the Real Estate Investing Abundance Podcast. I'm your host, Dr. Allen. I know you're excited to get into today's show, but I have a very exciting announcement to share with you before moving to the show. We've just launched a complimentary and comprehensive webinar that, among other things, shows you how to legally use passive real estate investing to reduce your taxes, recession-proof your nest egg, and take the sting out of inflation. If you are curious to learn more, go to stevetucker.com/webinar. It is complimentary and only takes a couple of minutes of your time. Once again, that is stevetucker.com/webinar. I'll see you in the webinar. Enjoy today's show. Hello, enlightened investors. This is the Real Estate Investing Abundance Podcast, and I am your host, Dr. Allen. So glad to be back with you again today. And we are going to look at building passive wealth with multifamily and self-storage. With us is Taylor Loht, and he is a multifamily and self-storage investor who helps busy professionals escape the Wall Street casino and build wealth on Main Street with real estate through his podcast, The Passive Wealth Strategy, and his company, NT Capital. So welcome, Taylor, and take us into the show and share a memorable experience that helped you to be who you are today.
Thank you so much. And there are so many that stick out. I think one that really still rings true to me today was, as I stand in front of you, I'm in my mid-30s, but I wasn't always, obviously. At one time, I started my career, got out of college with a degree in chemical engineering, got my first job, and it was the wrong fit for me, or I was the wrong fit for it. And over the course of a couple of years in that position, I really spiraled and I really struggled, not just at work, but in life. I was just completely miserable, frankly, drinking way too much. I'd moved away from all my friends because I moved away to a different area from college. And I think that it was difficult at the time, but that helps give me a lot of perspective today. And I think helped set me on a course to just general life fulfillment and understanding what makes me happy, but also I think more importantly, makes me satisfied, which is critical.
Well, let's get into real estate, Taylor. And what are the top factors that hold back new real estate investors?
Absolutely. So there are so many that your listeners may or may not be familiar with, but really it boils down first off to not understanding your why. Now, your listeners may be familiar with that. They may have heard of that before, but if you're really struggling with getting started, it can be oftentimes because you don't have a powerful enough reason to begin to take action and take those first couple of steps forward in your business. You don't have enough of a powerful motivation to get you started. But let's say you do have a powerful motivation, you're willing to take those first couple of steps forward. And this is the kind of next brick wall that folks run into is they have some capital, they have some time, they go to a networking event or they listen to a podcast and they hear about a great program, educational program, coaching course. And hey, they put the money down, they sign up, and then they get educated in a particular area of real estate, but they still feel that they don't quite know enough. So they think, oh, if I just go learn a little bit more, then I'll be ready. So they go invest in the next program and the next program. And that just repeats over and over again, because really, no matter what, we're all somewhat venturing into the unknown when we get started. It's just, you have to have that willingness to step outside your comfort zone and, do something, make an offer, do a deal. But so many new real estate investors get stuck being seminar junkies, is a common term. And they might know their why very well. They might know why they're there, but they're not quite willing to step outside of their comfort zone enough to make a deal happen. Then the third huge one that I see impacts so many people, and this is really the one that got me the most at the beginning, is shiny object syndrome. When you're not committing to one particular strategy or asset class or market or what have you, you start working on one for a little while. Maybe you work on it for a month, 2 months, 3 months, and you're not seeing the progress that you had really hoped for, which is normal. It can take a while, especially to do that first deal. And you think, oh, this just isn't working for me. And you just so happen to be reading books or listening to podcasts, attending REIAs, and hearing about all these great ideas that people are having success with. So you think, I'm just going to go try something else. I'm going to change paths. I'm going to move to this other shiny object. And for so many people, that process of investing a couple of months into it, not really seeing the progress they wanted and looking for the next shiny object repeats over and over again. And it really feels like you're getting started because you're investing that time initially, but you're also oftentimes getting just so close to that diamond in the mine. You're digging the hole, digging the mine, and you might be just a couple of feet away from that first diamond, but you just think it's not working out and you move on to the next one. That's not to say we need to get horse blinders on, if you will. And if we're going with Steed Talker Capital metaphors here, we don't need to get horse blinders on and stick with just one thing if it's not working out. We just need to really understand and be honest with ourselves if we're committed to a path, if we've really invested the time and energy and effort that's required to make big strides, especially in the beginning, because that first deal is pretty much the most difficult to get done. That's not to say that the subsequent deals get easier per se, but once you've done one, you understand what it takes to get one done, the steps that you need to take to get there, make sure you're on the path. You just keep getting better and better at it. And that shiny object syndrome is another huge one that impacts a lot of folks. So not knowing your why, not staying committed to one path and really taking the actions that are required, just thinking that you're not knowledgeable enough, just becoming a seminar junkie and then becoming getting subject to shiny object syndrome. And that's the one that really has, especially early on, impacted me the most. But many of us, whether you might have experienced one of those, or you've probably seen other folks come under the spell of one or more of those issues over the years. And it helps if you understand it so you can work through it and, know where you are.
Well, thank you for breaking that down, Taylor. I've certainly fallen into all of those categories, not so much the first one per se, but certainly the other two. And really, like you, the shiny object has really been the one that has really gotten in my way. Well, because there are so many opportunities out there in real estate, and there's such a variety of them. And when you're talking to those who've been successful in any one segment of that, they can make it sound so good and alluring because, well, in a lot of ways, it is good. But yeah, you are absolutely right. In order to get going, you really need a path, and you need to stay on that path. And that takes commitment and some resilience as well. Well, what are a few of the red flags in passive real estate investing that we passive investors really need to be aware of? I'm sure there's a lot of them, but what are the most basic?
That's right. There absolutely are a ton of red flags in passive real estate investing. If we try to go through all of them, we're just going to be here all day, but I'll line out a few that I've identified over the years. So the first one really comes down to the experience of the sponsor and the operator. If you're getting into a deal with somebody who's never done a deal before, that can be a huge problem, right? Allow somebody else to give that sponsor their capital and allow that sponsor to take the risk with their money. Don't take the risk with your money necessarily. So invest with sponsors who have done deals before. I think we've seen a little bit of a waning of that as interest rates have gone up so much. In years past, there were a lot of brand new people getting into deals, and we've seen some troubled deals and foreclosures from essentially brand new sponsors who didn't really know what they were getting into pop up and have problems. So yeah, the sponsor is huge, and their track record is very important. Another very important one is, so when you're investing passively with a sponsor or operator, you're generally going to be dealing with their investor relations department and or somebody that's in charge of the investor relations role. And before you place capital with them, you need to make sure that they're knowledgeable as to the business plan, the strategy, and everything around it. But you also need to make sure that they're responsive, right? You need to make sure that they answer your emails and your questions in full, promptly. And if they don't have the answer right away, they go and get the answer. So you need to make sure that they're there for you. I think another big one is for the passive investor. If you're investing in new deals for the first time that you don't really understand, there should be an internal red flag for yourself. You're investing in a business that you don't really know how to vet if this is a sound deal or a sound business plan at all. Is this operator capable of making projections that could have any bearing or could have any relevance to reality? We've seen some deals go wrong recently that, to someone who is knowledgeable, looking at the proposed deal structure or what was going to be put in place, you can pretty quickly see that not everything's adding up. You might not see right away that it's a out and out fraud, as some of these have been, or that it's just a flawed plan, but there's something, a gut instinct that you get and build over time. If you're brand new, one of the ways that you can work to build that gut instinct is just by reading and getting educated. Now, I kind of, shot down getting educated a little bit earlier, but certainly don't want to discount the value of education, no matter what you're doing in real estate investing. Another one that last one I'll throw out here is, as the market has matured and prices have gone up, and things have just changed over time, it's become harder to find deals for everybody, right? It's become more difficult to find deals. So many operators have branched out into brand new markets. And that's okay. Going to new markets is not a big issue. But some of them have gotten into new markets without doing, frankly, adequate due diligence and research on the market itself. They haven't gotten into the city or submarket to really understand its dynamics. And along with that, oftentimes they're leveraging the knowledge or experience of a property manager. Now, you can only really take that so far, but if you're getting into a market and into a deal where your property manager is an expert in that market, you have a strong relationship with them, then they might be able to provide some guidance for you. But there have been scenarios where operators are getting into new markets with property managers who are also new to those markets and therefore don't really understand the market dynamics in that area, whether it's just, how pricing works, or, how to price competitively for a, B-class apartment in a certain area or a submarket. They don't understand kind of where the invisible lines are in the area between the various submarkets. They may or may not understand the eviction process in any given city. They can, learn those things. But when you have a sponsor who's new to a market, along with a property manager who is also new to that market, then that's just a big recipe for trouble. And, we've seen folks have issues as a result of, just being too driven by the numbers on the page that they think they can achieve, and not being informed enough about where they're investing and what they're buying.
Absolutely. Excellent points. And to your third point there, are the projects reasonable, and do they make sense? If you are a new investor, reach out to people who are experienced, because an experienced operator can look at a pro forma and a proposal, and they can start immediately just picking out the issues that may be a problem there. And if you're not experienced of that, you just are going to glance right over those without even paying any attention at all. And then operators operating in markets they don't know is certainly a problem. And if they are, like you said, working with a property manager who is also new to that, you're just looking at a shipwreck because you've got to know the market you're investing in. Absolutely. Excellent, excellent points, Taylor. So, what are the biggest mistakes that you see passive investors making?
That's a great question. I think it really, again, we're gonna take education off the table because so many real estate investors, on my show, I try not to get too hung up on that because that's always the recommendation is go get more educated. And that's very important. So we're just going to say that go get more educated on how these various deals work before you go and invest. I think a big one that is very common is just looking at the return projection, whether it's just looking for the final projected IRR number or cash on cash return or whatever your favorite return metric is, just saying, oh, this guy's saying he's going to get me X return. I'm not going to say a specific number, but hey, that looks great. And not really understanding the actual business plan that goes behind it, because especially when you're investing passively, you're looking at, numbers on a page. And when someone's underwriting a real estate deal, they're punching numbers into an Excel spreadsheet. But if those don't have a bearing on the, if reality doesn't have a bearing on the numbers that go into the underwriting, then the projection of a, fantastic return can be just air, right? You're not going to actually walk into, a reasonable deal. I think another very common one is folks probably don't read their subscription documents enough and don't understand those documents well enough. When you get into a syndication deal, you might get a subscription agreement, a private placement memorandum, and that can be 100+ pages of complex legalese. And people have limited time in their lives, certainly understand that, but really digging into it and understanding what you're agreeing to and how the deal is going to be structured and the risks and everything, my opinion is that it's worth investing the time in understanding, what you're signing on to and how the deal is going to be structured. And, so many of those agreements, less scrupulous operators have used kind of weaselly language, if you will, to make the agreements slightly but importantly different from potential interpretations of, say, their slide deck or their presentation. So I think really digging in and understanding what you're agreeing to is worth the time and worth getting into. And, that unfortunately makes it a little harder to say that they're entirely passive deals, right? There is some investment of time up front in vetting the sponsor first, before you look at a deal, vet the sponsor and know who they are and, do your research, talk with experienced people and who are well networked and see if this person or this group has a good reputation. Then when you finally get a deal, read through the documents. It can take you time, but as you get more experienced with reading those documents, it becomes less, difficult. You can also hire attorneys and professionals to help you with that, which has a cost to it, of course. But I think investing the time and understanding what you're agreeing to is well worth it.
Yeah. Enlightened investors, if you haven't done so already, be sure and click that like button and also click that share so others can take advantage of the content. And finally, be sure to subscribe so you don't miss a single one of our upcoming episodes. And I would think if you're a brand new investor to this aspect of passive investing, those documents you're talking about, the subscription agreements, the private placement agreements, they're thick. And if you're new to this, I would certainly recommend an attorney, at least for the first couple of times that you're investing. They'll help you understand them, and they'll be sure that you're not getting into got you kind of contracts, and they can be out there. So you need to be wary of those. Well, you do both multi-family and self-storage. When you're looking at markets and investigating these two different kinds of opportunities, what are the things that you are looking for, and how do they differ from one segment to the other?
Great question. So, real estate investing, no matter what asset class you're investing in, is a supply and demand calculation, essentially. And the dynamics of multifamily supply and demand compared to self storage supply and demand are very different because they're different asset classes. But fundamentally, multifamily, we really focus on things like migration, jobs, what does the employment base look like? How diversified is it on the migration topic? Are people moving to the market or are they moving away? Very important. Of course, we look at things like landlord tenant friendliness, very important because it's generally, more difficult no matter where you are to evict someone for not paying from a multifamily as compared to a self-storage property. And of course, we want to understand the submarket and its local dynamics, local supply and demand, but self-storage is much more sensitive to nearby supply and demand dynamics than multifamily is. In the self-storage space, we look at typically drive radius or drive radii. The kind of historical strategy has always been looking at 1, 3, and 5 mile drive radius, looking at the competitors and the population. Again, going back to supply and demand in those areas, because people aren't going to drive all that far for a self-storage facility. They're probably going to pick one that's nearby their house, and you need people to be nearby. There are newer tools available that some folks have incorporated in their self-storage businesses that will look at actual drive times. It's just a more complicated, calculation to run, but there are, programs that'll do it, very easily available, and it's, not hard to find. But again, comes down to supply and demand, but the actual dynamics of supply and demand between multifamily and self-storage differ. Another important one is that most markets around the country, when it comes to housing, have a shortage. Most markets need more housing of some kind, whether it's apartments or, single families or whatever. They just need more units to put people in because people are moving there. Some markets are not, but as a broad generalization, that's true of most areas. Whereas major metros in the self-storage kind of realm, major metros have gotten overbuilt in some areas because it's comparatively easier to build a self-storage facility. It's concrete walls, some steel doors. If you're, putting climate control in there, then that adds additional cost, but it's just less expensive than multifamily. And that's led to, again, oversupply in many areas. So while it's always important to look at supply and demand dynamics, you're just especially in major markets, you're more likely to see an oversupply that is suppressing prices in self-storage than you are in multifamily generally.
Yeah, that's what I wonder about in terms of self-storage is that oversupply. But it seems like the demand keeps on going. Americans just like to keep junk and they need some place to put it. So it doesn't seem to be going away. But yes, I can see how just driving through various different locales, it looks to me like a self-storage on every corner, and it's like I don't know how they're going to sustain that. But anyway, so Taylor, tell us about yourself, your business, and what you have to offer our audience.
Sure. So as we discussed, I invest in multifamily and self-storage real estate. My business is focused around raising investor capital for those opportunities. And, we finding the best sponsors that we can with the, best deals that we can that are the right fit. And, essentially connecting the two together. My company, NT Capital, ntcapitalgroup.com, doing multifamily and self-storage deals pretty well spread out around the country, getting a lot of diversification, and that's changed and grown over time. I think this model enables us to invest in several markets in different asset classes without succumbing to shiny object syndrome, as I mentioned earlier.
Yeah. And how can we find you?
Sure. Folks want to reach out directly. My email, Taylor, Taylor, at ntcapitalgroup.com. You can find my podcast, The Passive Wealth Strategy Show, new episodes every Monday, Tuesday, and Thursday, passivewealthstrategy.com. Or we talked about red flags. I have a free 7-day video course on red flags in passive real estate investing, passiverealestatecourse.com.
And all that information is in our show notes. So for our last segment here, Taylor, one difficult setback in your life, and describe that to us. And how did you come through that? And what did you learn from it?
Absolutely. So I'll go back to what I said at the beginning of the show, because it was very important to me, was starting my career. This is back in 2011, so it was a while ago now, but starting my career at the time, doing something that I always thought I wanted to do, and it turned out that it was the completely wrong fit for me, and I was the wrong fit for it. This is not a judgment thing. It was just the wrong match. That led to probably, I guess, about 2.5 years of just going down, and it was just awful and really put me in a bad place. And how I got out of that was, frankly, being willing to step outside of my comfort zone and take a risk, especially for, at the time, it was silly that in hindsight, that I wasn't willing to take the risk earlier, because I was a young man in my early 20s, no obligations. I didn't own a home at the time. I'm married now. Obviously, I wasn't married at the time, didn't have really anything that could super duper go wrong, but still it was that fear of stepping outside of my comfort zone. But ultimately making that step and getting pushed to the point where I needed to make that step, it changed my life for the better. And, it was difficult to go through at the time, but in a way grateful that I did.
Yeah. Well, what are you most grateful for?
Wow, that's funny. I forgot the second question was what I'm most grateful for. I think the best answer that I can give is family. I have the best parents. They're in their 60s. They're still around. I see them and talk with them, pretty regularly. We live in different areas. Relatively recently, just a few months ago, got married. So, growing the family in that way. And without such great people around me and influencing me, then, nothing would happen. When my now wife and I first got together, I was, happy and things were going well. But since that time, just everything has grown and improved so much. Money, yes, of course, that's grown, but that's not everything. Life satisfaction, general just trajectory of what I think about and what I want to achieve in life has grown so much. And so family.
And 3 good things from the last 24 hours.
So right now I'm in my, I think, fourth attempt at a program called 75 Hard. I have actually completed it once. I've failed a few times, but the key is to come back to it. Essentially 75 days of working out twice a day, taking cold showers, following a diet, and reading 10 pages of nonfiction a day, which I like doing, but if I'm not keeping myself to it, I'm just going to put it off and not do it. So right now, the nonfiction book that I'm reading is Building a Story Brand. There was a really fantastic lesson out of that. Another great thing is, so my wife used to be a teacher. She's now no longer a teacher. She works at a local small business that she is aiming to buy, and we're working through that. But she's actually home today. So I got to spend some time with my wife this morning. And then number 3 is, I mentioned I'm reading a great book now. Well, I'm writing a book that I hope will be great. So I got to invest some time early this morning after my first workout, about, just 10 minutes or so worth of writing on the book. And it's always just, putting pen to paper can be difficult to start, but actually doing it, I always feel great at the end.
Yeah. Well, how are you putting your success as an investor and entrepreneur to work to create universal well-being for all beings?
So my business is very heavily based around serving investors, right? So that's the actual how the business functions, is just keeping them, happy and matching folks up and everything like that. But, for myself, this is something that my goals have changed so much over time for the positive. I used to care much more about like material wealth and success. And now that I'm at the point where I could have a lot of that stuff, I choose not to because my goals have changed in that. So now I've been a vegetarian for 8 years or so. Yeah, 8 years, 7.5 years. Sorry. And my goals have changed so that I contribute to animal shelters now, and my lifetime goal of being able to contribute to animal shelters has expanded considerably. And honestly, that's more motivating than the material stuff. Because at the end of the day, you have a nice car. I have a decent car, but if you have a nice car, at the end, it just becomes your car. You kind of stop caring about it. You have a real nice phone. I bought nice phones over the years. Eventually, it's just a phone. Who cares? But having something to contribute to, I think, is much more motivating.
Yeah.
It helps you show up every day.
Yeah. Well, imagine you've come to the end of your life and you lay on your deathbed. What do you look back on as your greatest joy and sense of fulfillment?
I probably think about things like this more often than I should, just in terms of planning things that I want to do. And future me looking back, I believe, will be grateful for the risks, now calculated and reasonable risks, but risks nonetheless, that I took to invest in myself. And I dislike that phrase because it's so incredibly vague. But like I mentioned earlier about writing this book, well, it's a financial investment, yes, but it's also an enormous time investment. And I think it's going to be my first one. I don't know whether I'll write more. We'll see how it goes. But I think I'll just generally be grateful that I was willing to make those investments in myself, investments in my future by saving money and investing it in things so that we can, generally have more and have passive income and be able to do the things that we want to do. So being willing to take risks and invest in myself, I believe will ultimately pay off, and I'll be glad that I did.
Well, Taylor, thank you so much for being with us today and enlightening us on passive investing. It's been a pleasure having you today.
Thank you for having me.
Enlightened investors, wait, don't go just yet. I just want to remind you about our recently launched webinar that you will not want to miss. If you're at all curious and would like to learn more about how real estate investing can diversify your investment portfolio, alleviate the anxiety associated with Wall Street swings, leverage your 401ks and IRAs to substantially increase the return on your investment, and do all of this with turnkey, hands-off passive real estate investments, then you'll want to immediately go to steedtalker.com/webinar. In the webinar, we'll also address the common dubious investment schemes that you want to avoid. To access the webinar, go to steedtalker.com/webinar. I look forward to seeing you in the webinar.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steed Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid passive real estate investments. As part of our efforts to make the world a better place, Steed Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steed Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at steedtalker.com.